So Barry, thanks for joining us for this interview. Tell us a little bit about your background and what you're doing, and especially what your organization is doing right now in view of the virus.
Most obviously, what I'm doing right now in response to the virus is I'm working from my home office instead of my office, because just before all this COVID-19 craziness broke out, I had a cross-country trip with multiple airplanes, multiple airports, in a group of 100 and some people, I think, who wanted to shake hands instead of doing the elbow bump. And so I'm working from home. My background, for those who don't know, I started in the investment business first, used tools like Morningstar to measure pricing and performance and document product recommendations for mutual funds in pension and profit sharing plans. I did that while I was actually in college. Graduated from college, went to go work for a life insurance agency where I was told that decision support for life insurance products was you run a hypothetical projection of something that's never going to come true, and you compare it to another hypothetical projection of something that's never going to come true, and that's decision support. And that just never made any sense to me. So you fast forward another number of years, and I took my experience from the investment business, the fiduciary investment business, and applied it to the life insurance business, and came to the conclusion that this $3 trillion industry that is life insurance would not go without published pricing and performance information forever. Somebody was going to figure out how to do something like Morningstar for life insurance. Applied for the first of our patents in 1999, was issued the first of our patents in early 2002, went online. Nobody cared while Bernie Madoff was sending out pieces of paper that everybody thought was just fine. But since then, people like Bernie and Alan Sanford reminded everybody it's a good idea to inspect what you expect. Could not be more true than as it applies to the life insurance products of today, as we've discussed in a number of other webinars. So I invented this company called Volatility that for a fee, you can get a report that provides an understanding and provides decision support and documentation for product recommendations according to that document their consistency with growing best interest rules, like in New York and various other states.
Okay, very good. So you basically run Veralytic, and you're a paid hourly consultant for many fiduciaries. You review life insurance policies, and you advise on how suitable they are as an investment and to provide a death benefit and what the alternatives are. And you obviously see some carriers that are typically better than other carriers, and some salespeople or consultants who do a more conscientious job than others, I'm sure. So
yeah,
what?
I run two companies. One of them is this company Veralytic that publishes pricing and performance research for free. It's all for a fee. It's all online. Anybody can get it any time of the day. Stick their credit card in their computer, and they get access to the Veralytic database. That does lead to consulting engagements where I also work for a fee. I also do work for a number of institutional trust companies with life insurance trusts. So I serve as sub-advisor to several thousand life insurance trusts, where in the same way that an investment trust has a investment advisor assigned to the trust, because the trustee's not picking stocks and bonds. The trustee's job is to know the fiduciary law in the state, know the terms of the trust, know the grantor's intent, know the beneficiaries, hopefully. But the trustee's not picking stocks and bonds. So there's a portfolio manager or an investment advisor assigned to investment trusts. That role does not generally exist in life insurance trusts, but it is a growing need. And so I serve as sub-advisor to my firm serves as sub-advisor to life insurance trusts, where we warranty best execution. And in those cases, we are paid a commission from the insurance company instead of a fee at the trustee or the trust company's direction.
Oh, great. So Barry, how is this virus affecting underwriting and the ability of people to get new life insurance policies?
So it's mostly affecting it kind of in a practical way. It hasn't really changed any of the underwriting guidelines. There have been some modifications, but it hasn't really changed any of the underwriting guidelines. There is, with a couple of exceptions, no new questions about COVID-19. It's really, as a practical matter, how do you satisfy the underwriting requirements that the insurance companies need in order to make a risk assessment? For instance, the insurance company needs medical records. So if a doctor's office is swamped and or they use a copy service and the copy service is not allowed into the doctor's office, then you just can't get medical records. That's probably the biggest issue because insurance companies are relaxing some of their guidelines on getting exams, which is the other thing, the other piece of information that underwriters need. Some insurance companies, some insurers are allowing applicants to forego the exam if there's not an examiner in their area, or if the applicant or the client has concerns about letting a stranger into their house with all this COVID-19 craziness. If the underwriter can get recent medical records and the medical records don't present any issues that they'd want to know more about, then some insurers and some underwriters are foregoing medical exams. In some cases, up to some really big policies. I saved a note from one of the carriers. So one carrier is allowing coverage up to $20 million for applicants up to age 65 if they're in white collar applications for only permanent types of insurance. And they're not really, in some cases, when insurance companies offer or relax their underwriting guidelines, they charge more. Like they won't give you preferred rates, they'll only give you standard rates. But this insurer is allowing better than standard rates. Another one is allowing coverage from 5 million all the way to 65 million, but again, limited by age, only up to age 70. And this other insurer, again, is not charging more. They're not limiting the health risk class. They'll go all the way to super preferred rates for both permanent and term coverage. So again, it is changing. It's having practical implications on the underwriting process. But some insurers and some underwriters are trying to come up with workarounds.
So at this point, the actuaries who work for the life insurance companies haven't said, wait a minute, we've got a pandemic, we've got to increase our rates to take into account that more of our insureds who we write policies on are going to die. Or I guess they're just assuming that this virus is going to be cured or go away before it would have an impact on future business.
So it's kind of getting into the way sausage is made, which some of your listeners or viewers may not want to, they might want to turn this part off, but getting into the way sausage is made. So the underwriters start with mortality tables published by the Society of Actuaries, the commission, or generally called the Commissioner Standard Ordinary Table. So they start with that table. That table is a table based on mortality studies. And then insurers have their own experience. And so then they modify this industry table to apply their own experience to come up with their own rates. And then they file those rates with the State Department of Insurance in 50 states and a couple of territories. And then that's what they end up charging. So to change their rates, they would have to have a basis for that change. They'd have to go to the State Departments of Insurance and say, look, we're not just concerned about what we actually have experienced adverse mortality for a particular something or another. And there's just not been enough time in this COVID-19 craziness to assemble any data, do any actuarial studies, to submit any requests for changes. So while some underwriters may be changing their underwriting guidelines, as we talked about a minute ago, and not issuing preferred if they can't get the data, they are not changing the pricing inside of the policies yet.
Okay. Then, do you see any changes coming with respect to the strength of this industry and the ability for people to get their cash value and to get their death benefits, given the new economic stress that is being put on insurance companies? They survived the 2008 recession very nicely.
Yep.
So do you think, are there any insurance carriers that are on their dying legs anyway that this may take down? You know, they have a lot of loans to big buildings. They've got a lot of, some carriers have bonds, junk bonds. What do you think this is going to do for the solvency of carriers?
So as a whole, let me first speak to the as a whole. As a whole, the industry was, and I think remains, more capitalized than other segments of the financial services industry, generally speaking. For instance, back during the financial crisis, AIG caused a big problem. Well, AIG was a big company. AIG had insurance companies, life insurance companies, but then they also had a number of other ventures. It was really the other ventures that caused the big problem: the credit default swaps, the counterparty. They were a counterparty to a good many of those risky, what is now understood to be risky mortgage assets. But that wasn't in their life insurance companies. In fact, AIG, before they got the government bailout, AIG parent company borrowed money from, I believe it was their New York life insurance company, because it was so well capitalized to keep them alive long enough for the government to bail them out. So the insurance industry is generally better capitalized or well capitalized than other segments of the financial services industry. However, you make a good point that there are fewer life insurance companies now than there were pre-financial crisis. While not, I don't know of any life insurance companies that went out of business during the financial crisis. A good many insurance companies got out of the life insurance business. So there are fewer life insurance companies today than there were back then. Part of that was due to the stresses of the financial crisis. Again, it might not have been in the life insurance product. No, in some cases it was in the life insurance product. So they got out of the they got out of the life insurance business. I don't know. I certainly can't predict any failures, but there is going to be potential for stress on life insurance companies. Lower rated companies should be looked at, absolutely positively looked at. Probably all companies and all policies should be looked at for some other reasons that I think we'll talk about, beyond just the company's financial strength. But there is going to be additional stress. The Fed is putting unprecedented amounts of liquidity in the system. So whether that stress manifests itself into a problem or not is to be determined.
Okay, very good. What is happening in the marketplace with respect to the ability of life insurance agents and agencies to make money? In situations like this, do consumers say, oh, I have plenty of time on my hands and I just lost a third of my net worth, I think I'll go buy some new life insurance? Or is this going to be a tough time for life insurance agencies?
So I've got customers. Volatility has a good many customers that are life insurance agencies. And I've gotten more calls lately about, what do we do? How can we, and I think that how can we use Volatility in our practice? Because maybe some of the other things that might have been working before aren't working, or because the the industry largely is a face-to-face industry, but information can be, Veralytic publishes information. So Veralytic supports conversations over the phone where you don't have to be face-to-face in front of the client to explain a 50-page, 400-number illustration, right? You can't do that over the phone. You can't explain an illustration over the phone, but you can explain a Veralytic report over the phone because it's one page and it's graphic and it's independent, right? I am getting more calls from life insurance agents and agencies, my customers in particular. I am also getting, in the work that my other company does for trust companies, I am finding, I kind of smiled when you said this, high net worth people, affluent people, they travel, they're busy, they have businesses that keep them busy, they have hobbies that keep them busy, and life insurance is generally not high on that priority list. But I will tell you, in the last week, I got through to more grantors of life insurance trusts because they're all stuck at home than I have year to date. So I think it's some of both.
Okay. Now let's talk about the 5 different main types or 6 different main types of life insurance when we go as to solvency. We have term life insurance, which I think remains nicely solvent if the carrier doesn't go under and if the reinsurance is real. We have guaranteed universal life, which is similar because the client really isn't looking at the cash value anyway. We have whole life, and we have universal life, which I think is pretty similar. With variable life, obviously people took a big hit to cash value and they'll hope that that picks back up, and they'll be encouraged by conscientious agents just to keep their allocation pretty much what it was, let the market come back. With equity index, there may be a windfall because most of those policies can't go negative this year. So if the market loses 70% this year, the policyholder still has their cash value. And then next year, if it goes up 5%, they're going to have a little bit of a positive. So I guess the equity index industry is going to have much higher cash values than the variable industry. Is that coming out of the pockets of the life insurance companies, or is that coming out of options and puts that they bought so that they remain solvent?
It's coming at it. I mean, they're buying effectively a collar around whatever index the policyholder allocates to. So whoever's on the other side of that collar lost that bet, and the insurance company is protected. So I don't see the insurers suffering from the downturn in the market in their index universal life policies. I also don't see, to the point you made, clients suffering. I mean, clients are protected by the floor in the index universe, by the collar, right? By the floor of the collar in these index universal life policies. But what is to be determined is the people who lost, the other side of the collar, who lost on this downturn. Options, when volatility is low, options are very inexpensive. You look at as a measure of volatility, you look at the VIX. The VIX has skyrocketed. Volatility went from into the 20s, into the 80s. It increased by 4-fold. When volatility increases and the other side of the collar loses, they increase the cost going forward of those options. When option prices are increased, the insurance company doesn't have as much leverage. They've either got more expense or they got to buy a more narrow collar. And as a result, the participation rates and the caps are already being announced that they're going down. So while the downside has been protected, which is a good thing, The upside going forward is almost certainly going to be less across the board and is already less in a good many products.
Okay, so the typical, I'm going to oversimplify, but the typical equity index product says, Mrs. Jones, we'll give you something similar to a rate of return based upon the S&P 500, for example, and it will be, if the S&P 500 goes down, you'll be at zero, you won't lose anything. If the S&P 500 goes up, we'll give you the upside. We won't give you any of the dividends that would have come out, but we'll give you the upside of the value of the S&P 500 without dividends, and no more than 8.5% in the year. So, but that 0 to 8.5%, which is in the policy, is our current collar, I'll call it. We have the right to change that collar.
The insurance company has the right to change that collar, not the policy.
Insurance company has the right to change the collar. So now the insurance company is going to say, wait a minute, we got to go buy the puts now so that we can get the 0 to 8.5%. That money comes from the people who sell us these derivative financial instruments. They're charging us more now. So Mrs. Jones, now the spread is 0 to 6.5 or 0 to 5.5. So we can expect those policies to change. And a lot of these policies are being sold to people by agents who say, this is pretty much a fairly safe 5.5 to 6.5% rate of return on average. And that they're not supposed to say that, but that's what they say. They all say it. Well, they don't all say it. You don't say it, and there's probably 4 other people who don't say it, but everybody else says it. Everybody else thinks it in their heart. But I guess they're going to say maybe 4.5% now. And maybe it's not so safe to leverage this thing with a 3% premium loan.
Yeah, I do think premium finance policies are at greatest risk here because interest rates are going down. So you know, I mean, premium financing adds another layer of complexity, another layer of moving parts. If the loan interest rate goes down and the rate of return that's reasonable to expect from the index universal life policy goes down, but the spread is maintained, then that transaction still works. But if there was ever a time that monitoring index universal life policies is important, because it is not I mean, it could be conservative, but it's not necessarily conservative. In fact, let me tell you an example. Here's where my skepticism comes from index products. And by the way, disclaimer up front, this is not to say that I think index products are inherently appropriate by any stretch of the imagination. I have clients who have index products, properly administered for the right risk temperament, for the right goals, circumstances, goals, objectives, perfectly appropriate. But it is not the conservative with upside, greatest thing since sliced bread that some people make it out to be. Here's where my skepticism comes from. I thought that the idea when index products were first invented, I thought they were a great idea. At the time, I had clients in public companies, and they had amassed a significant amount of wealth by taking their company public or by being part of a public company. And they were more concerned with preservation of that significant increase in wealth over a short period of time than they were in, you know, shooting for the moon anymore. So they would put a collar around their stock. Downside protection, I'll take some upside, but I've already made a lot of money. I don't need to do it again. I just want to keep what I got, right? You need to have, but that collars are not available to the average Joe. They're only available to high net worth individuals. So the index product to me was this great idea. It brought collaring, the investment strategy of collaring to the average Joe. And so I had young kids at the time. I took my kids' college education and I looked for an indexed annuity, found an indexed annuity. The indexed annuity offered a 70% participation of the S&P 500. So I know that the S&P 500 back then, probably pretty close to this day, since 1929 has averaged 10% over various 20-year periods, right? So 70% of 10 is 7%, tax deferred because it's in an annuity, no downside. So if the market crashes, I've not lost my kid's college education. I thought this is a perfect application for the use of a collar. Lo and behold, I put my kid's college education money into the annuity. The very next year, the participation rate was changed from 70% to 30%.
Oh,
Now, I've got no better than a CD, and in a CD I can't lose money, or I can't get zero. So I've got no better than a CD and risk that I could go to zero. That's the skepticism I have about indexed products. I think it's a healthy skepticism that you've got to examine what is going, what's the carriers, what are they charging inside the policy? Is it competitive so that if you do get zero, you're not losing your principal to high costs? And the indexed rate is driven more than anything else by the company's earnings on their general account portfolio. So are they a good performer in their general account? Those are the things that I think have to be examined if you have or if you are considering an indexed universal life product, particularly going forward. And both of those things, by the way, are measured in Veralytic reports.
And it's interesting that it seems that only the insurance company has brought this to the average Joe, and even really wealthy people, they can only get this on a stock by stock basis. I don't know that there's anybody that's collaring the S&P 500 outside of the insurance agent industry, which seems strange to me because with annuities, it all ends up being ordinary income when you pull it out.
Yep.
Versus the S&P 500, mostly it's capital gains at a low rate or a 529 plan holding the
Yep.
equivalent of the S&P 500.
Yep.
So Barry, what else should we discuss with reference to the virus and what's happening today with life insurance, or have we discussed it all?
Well, you mentioned several other product types. Products that have a declared rate of return, we thought we were near the bottom of the low interest rate environment, but it could go lower. Older products have higher crediting rates. Older products may have an advantage. Older products have higher guaranteed minimum crediting rates. So older products may have an advantage over newer products. You got to make sure you understand what's going on inside the policy. Older products can also have higher costs. So you got to evaluate. So I'm going to receive a higher interest rate on my older product than I can possibly get out in the open market nowadays. But how much am I paying for that interest rate? So you got to understand the cost and the performance. There are insurance companies that have offered guarantees, and in the low interest rate, as the low interest rate environment kept getting lower and lower, the guarantees were putting pressure on them, particularly in environments like this. And so they actually started charging, some insurance companies started charging more to their non-guaranteed policyholders, to the policyholders that had non-guaranteed products. They started charging them more because of the added expense of the guaranteed block. They couldn't change the charges inside the guaranteed block. But to maintain their financial strength and claims paying ability, they started charging the policyholders that actually weren't causing the problem. So if there was ever a time to make sure, one, to review your life insurance. I've been saying that it's the last largest, most neglected asset on clients' balance sheets anyway. So I have generally said that it's prudent to look at the cost, look at the performance of life insurance, but even more so nowadays, given the changes to the index products, the changes to the interest rate products, and the potential financial pressures that certain interest-bearing products are going to bear on the financial strength and claims paying ability of the companies.
And I think you may see term and guaranteed universal life rates come up soon when the industry has to reckon with the fact that the rates of return they can expect are not going to be as high as they've been. So if you're going to buy life insurance, I think you buy it now. Even if you're going to buy equity index, the guarantees they're giving you now as to the spread are probably better than the guarantees you're going to see 6 months to a year from now, the next time they re-up their rates with the commissioner, I would think.
So could not agree more. Even before the financial crisis, the frequency of product updates is changing at a pace that I've never seen. It used to be, you'd think of a life insurance policy kind of like a closed-end mutual fund. You know, you open up the fund, the insurance company negotiates a reinsurance treaty with the reinsurer, and they can only place so much insurance before that reinsurance treaty is maxed out, and then they got to issue a new policy. And that used to be kind of in broad brushstrokes what determined the lifespan of a policy. Call it 18 months to two plus years. Last year there were some changes in reserve requirements, and so everybody repriced their products toward the end of last year or very early this year, and we're already seeing reprices before the before this COVID-19 craziness and the impact on the financial markets, and we're hearing rumors, we're getting formal notices of the changes to the indexed crediting rates, participation rates, and caps. And we're hearing rumors that another round of repricing is coming in May with some carriers. So yes, understand what you have and both from a term, universal life, whole life, and indexed products, review and make some decisions over the short term could be making some decisions over the short term could be beneficial. The other, I mentioned some of the conversations I'm having with grantors. You know, some of these trusts have whole life policies or universal life policies in them that were placed years ago. They didn't necessarily know what they were buying. You know, they were buying insurance, so it was just insurance. And we in having the conversation that a portfolio manager would have for assets in a trust, we talk about the risk profile of the client. And in two cases, the client says, look, I'm not risk averse. You know, I believe in equities. And by the way, I had that conversation, both of these clients said, I'm not risk averse on a day the Dow was down 1,000 points. That's somebody who is demonstrably, sorry, not risk averse, risk tolerant. That's somebody who is demonstrably risk tolerant. When you say that the day the Dow is down 1,000 points, that's somebody who's risk tolerant. And so, and they were both lamenting, I just wish I had some dry powder. And I said, well, actually you do. You've got hundreds of thousands of dollars that have to be invested in high grade bonds and government-backed mortgages, which you're telling me is inconsistent with your investor temperament. If you were to move that from the current universal life or whole life, where it has to be invested in a conservative allocation, into a variable chassis, by the way, you're being overcharged in those other policies anyway. So you move, transfer the account from where it is to a new insurer that charges less and gives them the ability to allocate to whatever asset classes are consistent with their investor temperament. And that's one reason why last week we had more activity in a week than we had year to date.
And thank you very much. This is very informative.
You're welcome. It's always fun.
All right. Take care.
See you, man. Thanks.
Be good.
Bye-bye.
Bye.